Decision-making tools. Data-based decision-making. Now, let us look at some tools that you can use on a daily basis in any company for decision-making. Many of these tools are simple tools. We need to start with simple tools, and then go on to more complicated tools. Cost-benefit analysis. Every employee who attempted an improvement in his company would have the experience of encountering a need to convince his or her boss for an approval for an improvement project that he or she had been planning, or a need to get the approval for a capital equipment that is supposed to increase the productivity of people on the shop floor. The bosses always expect a numerical value to the benefit that you are talking about. They would expect a return on the investment that they are making. It is smart to back up your proposals with a simple cost-benefit analysis. A cost-benefit analysis, as the name suggests, requires you to compare the cost of an improvement or investment to the benefit that is expected from that improvement or investment. While working out the costs, all direct or indirect costs will have to be considered. Benefit is generally taken in terms of annual benefit. Example: you are proposing an improvement in a machine in your shop floor that you expect to reduce the rejections in that process. You also expect an improvement in productivity with the new machine. Cost. Cost of the machine is equal to 5 lakh. Cost of installation and commissioning is equal to 50,000. Total cost is equal to 5,50,000. Benefit. Lower rejections in 1 year is equal to 1,50,000. Less, higher power that the machine will consume is equal to 35,000. Improvement of labor productivity is equal to 50,000. Total benefit is equal to 1,65,000. Payback is equal to 5,50,000 divided by 1,65,000 is equal to 3.33 years. Case study. You are leading the productivity improvement team in your plant. Your team has worked out an idea by which you can improve the productivity in 2 operations by 25%, which results in the reduction of 16 man-hours per day. The manpower used in this area is temporary manpower, and it costs rupees 300 per man-hour. This improvement that you are suggesting also reduces the rejections from 10 pieces per day to 5 pieces per day. The cost per piece at this stage of production is rupees 500 per piece. This improvement requires some modifications in the machine and layout, which costs rupees 2,50,000. These changes in the machine and layout require a regular maintenance, which requires rupees 15,000 per month to be spent. This investment decision can be taken by you. Management has authorized you to take decision yourself. The management always insisted that you should take a decision for investment only if the payback is within 2 years. What would be your decision? Please fill up the details in the workbook given to you. Break-even analysis. Every business looks to make profits. This is the primary aim of any business. Hence, any new products that are being launched, or new divisions being launched, or new companies being set up, should consider the issue of when they will start making profits. When a new business is set up, the sales will not take off immediately. Every company has to work hard to increase the sales. This is the same when a new product is launched in an existing company. The managers need to know when the new product will start making money. How many units should they sell to make money? Every company will have fixed costs as well as variable costs. Fixed costs. Fixed costs are generally not related to the level of production. They have to be incurred anyway. Some of the examples of fixed costs are salaries of the managers and staff involved, power of the sales office, administrative office, travel expenses of senior people, sales team, statutory payments that the company has to make. These costs have to be paid from the revenues, from the sales of products of the company. Variable costs. Variable costs vary with the production of each product. Some of the examples of variable costs are as follows. Raw material for each product, power required to produce, direct labor required to produce, consumables for production, packing materials cost. Contribution. Contribution per sale of 1 unit of product is equal to sales price minus variable cost for 1 unit. Break-even sales volume. This is the volume of sales at which the company will neither make profit nor loss. Break-even sales volume is equal to fixed cost divided by contribution per unit. Sensitivity of break-even sales volume. The BES volume can be affected by any of the following changes. If the fixed cost of the company increases due to recruitment of more staff, or due to the higher travel cost of executives, or due to installation of more air conditioners in the office which increased the electricity charges. These are only some examples. If the sales price of the product is reduced due to competition in the market, if the variable cost of the product increases due to higher rejections in the shop floor, or due to higher customer complaints, etc. With the good efficiency, if the company can control fixed costs and variable costs, the company can lower BES volume. Company can start making money early. If the product design is such that the product is very much sought after in the market, then also the BES volume can reduce. Example. A company has launched a new product. The cost details of the product are as follows. Fixed cost, rupees 5 lakh per annum. Variable cost in rupees per unit. Raw material, 150. Consumables, 50. Power, 50. Other variable costs, 100. Total variable cost, 350. Sale price of the product, per unit, rupees 550. Contribution is equal to sale price minus variable cost per unit, 550 minus 350 is equal to rupees 200 per unit. BES volume is equal to fixed cost divided by contribution per unit, 5 lakh divided by 200 is equal to 2,500 units. Unless the company is able to sell 2,500 units in 1 year, the company cannot make profit. This can also be understood that, per month they have to make at least 2,500 divided by 12 units to strike BES volume each month. Case study. A company has launched a new division in their company. It has set up a separate factory for this purpose. A new factory manager and entirely a new team is recruited. The factory building has been taken on rent. A new product development team had been set up. The factory started off with the development of the new products. It took nearly 12 months to come out with a new product and test it before it was ready for commercial sales. The annual fixed cost that the company was incurring for this new division was as follows. Fixed cost elements. Salaries of all the staff 25 lakhs. Rent for the factory 6 lakhs. Travel expenses 2,50,000. Power for the office 1 lakh. Other fixed costs 1,50,000. Total fixed costs 36 lakhs. The variable cost of the product is as follows. Variable cost elements. Raw materials 500. Consumables 150. Power for production 200. Labor cost 150. Other variable costs 100. Total variable costs 1,100. The sale price of the product is rupees 1,500 per unit. Please calculate the break-even sales volume of the product. Also, please study the impact of following changes on the break-even sales volume. The new product development team wanted 3 more engineers. This needed investment of another rupees 4,50,000 per annum. The travel expenses increased due to more travel of the team by another rupees 1 lakh. The raw material cost went up by 20%. The state government increased the per unit price of the power by 15%. The manufacturing team wanted another 20 people on the shop, which increased the labor cost by 10%.